Think about the thousands of hours engineering teams spend perfecting a software codebase. Now consider this. The average SaaS company spends just 8 hours in its entire lifetime thinking about pricing. They default to what is easy. They tally up their server costs, slap a margin on top, or copy their competitors' pricing pages without ever testing if those numbers actually make sense for their buyers. This leads directly to chronic underpricing. Founders often assume buyers want the cheapest option, but to an enterprise buyer, a price that is too low signals that the product is low quality or that the company won't survive the year. You end up leaving massive amounts of revenue on the table. To survive in the software market, you have to master a single equation, the ratio between lifetime value, or LTV, and customer acquisition cost, known as CAC. For a software business to be healthy, it needs a minimum ratio of 3-to-1. That means for every dollar spent acquiring a customer, the company must generate at least $3 in profit over that customer's lifespan. If you ignore this math, your product will eventually burn through its cash, no matter how elegant the code is. Nailing your pricing strategy is the ultimate lever for scalable growth. To find your fully loaded CAC, you take your total sales and marketing spend and divide it by the number of new customers. A truly honest calculation includes sales salaries, commissions, software overhead, and marketing agency fees, not just ad spend. Many companies inflate this cost unnecessarily by making it incredibly difficult to actually buy the product. They force new users into rigid annual commitments, paid upfront before the user has experienced any value. You can remove that buying friction through strategic packaging. By offering a pay-as-you-go model, an entry-level tier, or a freemium option, you let customers buy the product exactly how they prefer to test new software. This table from the Amplitude Guide to Product Metrics maps acquisition directly to activation and retention. It shows that when you remove initial friction, you accelerate product-led growth. You create a seamless pipeline where an acquired user quickly becomes an active, retained user. By aligning your packaging with buyer preferences, you drastically lower the hurdles to adoption. This mathematically shrinks your CAC denominator, instantly improving your overall ratio. To calculate lifetime value, multiply average revenue per user by gross margin and divide by churn rate. A critical mistake is using gross revenue instead. This creates an illusion of profitability. You must use gross margin, revenue minus direct costs, to see actual cash available. To legitimately increase this numerator, you have to implement value-based pricing, charging customers based on the perceived value they get from the software, rather than your production costs. That requires selecting the right value metric, the specific unit of consumption a customer pays for. A common error is rigidly charging per user seat, even when the software's value doesn't actually scale by the number of employees using it. Instead, the metric needs to align perfectly with customer success. HubSpot charges per marketing contact. Wistia charges per video view. Stripe charges a percentage of transactions. When you select a value metric that captures true perceived value, your LTV numerator expands organically as your customers succeed and grow. To maximize lifetime value, you also need to track net dollar retention, or NDR. This measures how much revenue you retain and expand from existing customers, and you want that number well over 100%. If you fail to offer an expansion path for your current accounts, you force your business to rely entirely on expensive, net new customer acquisition to keep growing. You solve this with hybrid expansion pricing, a good, better, best tier structure, combined with usage-based add-ons. As a customer uses the software more, they hit a limit that automatically triggers an upgrade, requiring zero intervention from a sales rep. Hybrid pricing extracts more revenue from your existing user base without requiring a single additional dollar of CAC spend. It acts as a massive compounding multiplier for your unit economics. Which brings us to the final, and perhaps most pervasive error. Too many companies treat pricing as a static decision, setting it once and refusing to touch it again. The LTV to CAC equation serves as a mirror, revealing whether you have priced your software based on internal costs or the actual value your customer receives. To get the math right, pricing requires the same rigorous continuous research, customer surveying, and A/B testing as any core feature in your software. Just like your UI and UX, your pricing strategy has to adapt. As your product matures and your target market evolves, your monetization model must iterate right alongside it. When product managers take ownership of pricing as a dynamic, deeply integrated feature, the unit economics solve themselves. You stop fighting to acquire customers and start using their success as an automated engine for scalable growth.